Okay, so, quick question. How much money does your bank actually have? Like, if everyone with an account at Chase Bank went to withdraw their money tomorrow, how much cash could they actually give out? You'd think it's dollar for dollar, right? You deposit $1,000. They have $1,000. Yeah, no. Chase Bank has to point for $1 trillion in deposits, but they only keep about $240 billion in actual cash. That's 10%. Where's the other 90%? It doesn't exist. It's not real. It's just numbers in a computer. Now, here's what's crazy. This isn't a modern invention. This isn't some digital age banking hack. This system was invented in 1397 in Florence, Italy, by the Medici family, and I'm going to show you exactly how they did it, why it made them the richest family in Europe, and why every single bank in the world still uses the exact same trick 700 years later. Because once you understand this, you'll never look at your bank account the same way. This is the accounting trick they don't teach you in school, and there's a reason for that. Stick with me for 30 minutes. This gets wild. Let's go. All right, let me set the scene. Florence, Italy. 1397. The Renaissance is just beginning. Art, science, banking, everything's changing. And there's his family, the Medicis. They're well merchants, middle class, not rich, not poor. The patriarch is Giovanni de' Medici, and this guy sees an opportunity. See, back then, the Catholic Church controlled everything, and the church had this rule: charging interest on loans is a sin. It's called usury. So, technically, banking shouldn't exist, but people still need to borrow money. Merchants need capital. The church itself needs to move money around Europe. So clever bankers found a loophole. Instead of charging interest, they charged exchange fees. Oh, you want to convert florins to ducats? That'll cost you 15%. It's interest, but they don't call it interest. And Giovanni de' Medici becomes an expert at this. He opens the Medici Bank in Florence. And at first, it's just a normal bank. You deposit gold. They store it. You want to make a payment. They transfer gold. Simple. But then Giovanni discovers something, a mathematical trick that will change everything. So here's what Giovanni notices. Most people don't actually withdraw their gold. They just transfer credits between accounts. Merchant A's merchant B 100 florins. Instead of moving physical gold, Giovanni just writes merchant A minus 100 florins merchant B plus 100 florins the gold. Never moves. It just sits in the vault. And Giovanni starts thinking, wait, if the gold never moves, do I actually need all of it? Now, this is where it gets interesting. Around the same time, a Franciscan friar named Luca Pacioli is developing something called double-entry bookkeeping. The idea is simple. Every transaction gets recorded twice. Once as a debit, once as a credit. Your deposit of 100 florins gets recorded as debit. 100 florins the bank owes. You credit 100 florins, the bank has your gold. Both sides balance. Beautiful, elegant, mathematically perfect. The Medicis adopt this system immediately. And here's why it matters with double-entry bookkeeping. You can track what you owe versus what you have as to separate numbers. You owe depositors 10,000 florins, but you only need to keep, say, 2,000 florins in the vault because most people never withdraw at the same time. So what do you do with the other 8,000 florins? You lend them out at interest or exchange fees. This is the birth of fractional reserve banking. You keep a fraction in reserve and lend out the rest. But here's where the magic happens. All right, this is the part that blows my mind. Let's say Giovanni has 1,000 florins in gold in his vault. Depositors think they have 1,000 florins, but Giovanni lends out 800 florins to a merchant. Now, the merchant takes that 800 florins and deposits it in the Medici Bank. Because where else are you gonna put it? So now the bank's ledger shows original depositors, 1,000 florins merchant, 800 florins total deposits, 1,800 florins, but there's still only 1,000 florins of actual gold in the vault. Giovanni just created 800 florins out of thin air. And it gets crazier. That merchant borrows 600 of his 800 florins to another person, who deposits it back in the bank. Now the ledger shows original, 1,000 merchant, 800 second merchant, 600 total, 2,000 for 100 florins from 1,000 florins of real gold. The bank now has 2,000 for 100 florins in deposits. This is called the money multiplier effect. And it's not fraud. It's not illegal. It's just math. As long as everyone doesn't try to withdraw at once, the system works perfectly. The Medicis just invented a way to multiply money, and they get rich. So, let me show you how powerful this made the Medici family. By 1429, just 32 years after starting, the Medici Bank has branches in Florence, Rome, Venice, Geneva, Lyon, Bruges, London. They're the first international bank. They're handling the Pope's money. They're financing kings. They're funding wars, and they're using this fractional reserve system in every branch. Here's how. It worked across branches. Merchant in London wants to pay someone in Florence, gives gold to Medici Bank in London. Medici Bank in Florence pays out gold to the recipient, but the gold never actually travels. It's just ledger entries, and because they're using fractional reserves in every city, they're multiplying money everywhere. By 1450, the Medici Bank has effectively created the first European monetary system. They're the Federal Reserve of Renaissance Europe. And the family becomes so rich and powerful that they basically buy Florence. Cosimo de' Medici, Giovanni's son, becomes the unofficial ruler. Not through military conquest, through banking. He funds art Michelangelo, Donatello, architecture Florence Cathedral, politics, the Medicis produced for popes to queens of France. All from a banking trick. But here's the thing. This system has a fatal flaw. Alright, so, fractional reserve banking works perfectly under one condition: everyone can't withdraw at once. But what happens when they try? Bank run. And the Medicis experienced this firsthand. 1464, Cosimo de' Medici dies. His son Piero takes over. Piero is not a good banker. He's impulsive. He makes bad loans. And people start to worry. Rumors spread. The Medici bank is in trouble. People start withdrawing gold. At first, it's fine. The bank has reserves. But then more people withdraw. And more. And suddenly, the bank doesn't have enough gold. They have to sell assets quickly to raise cash, which makes their financial position look worse, which causes more people to withdraw. It's a death spiral. The bank survives, but barely. Piero has to shut down several branches. And here's the lesson the Medicis learned: fractional reserve banking is incredibly profitable. Until it isn't. When confidence collapses, the system collapses, and this lesson gets learned over and over throughout history. Okay, so the Medici bank eventually fails in 1494, but the system doesn't die. It spreads. Dutch bankers in Amsterdam adopt fractional reserves in the 1600s. British bankers in London adopted in the 1700s. American bankers adopted in the 1800s. And every time, the same pattern: banks multiply money through fractional reserves. They get rich, then eventually there's a crisis, and the system almost collapses. Let me show you a few examples. 1720, the South Sea Bubble. British banks lend massive amounts using fractional reserves. South Sea Company stock becomes a bubble. Bubble pops. Banks can't collect their loans. Multiple banks fail. 1819, first U.S. banking crisis. State charter banks issue paper money backed by fractional reserves. Overlend during a boom. Boom turns to bust. Banks can't redeem their paper money for gold. Crisis. 1907, panic of 1907. Trust companies in New York use fractional reserves. Stock market crash triggers bank runs. JP Morgan has to personally bail out the system. 1929, 1933, the Great Depression: banks across America using fractional reserves. Stock market crash triggers mass withdrawals. 9,000 banks fail because they don't have enough reserves. The pattern is always the same. Fractional reserves work great until suddenly they don't. Alright, so after the panic of 1907, the US government says, we need to stop these bank runs. So, in 1913, they create the Federal Reserve. And here's what's fascinating: the Federal Reserve doesn't stop fractional reserve banking, it institutionalizes it. They make it the official system. Here's how it works. Banks are required to keep a certain percentage of deposits as reserves. The reserve requirement. Originally, it was 10%. Now, it's actually 0% as of 2020, but we'll get to that. So, if you deposit $1,000, the bank keeps $100 and can lend out $900. That $900 gets deposited somewhere. Bank keeps $90, lends out $810. That $810 gets deposited. Bank keeps $81, lends out $729. And so on. From your original $1,000 deposit, the banking system creates about $10,000 in total money supply. This is the money multiplier. And it's the exact same system the Medicis used. But now there's a safety net. If a bank runs out of reserves, the Federal Reserve will lend them money. The Fed is the lender of last resort. This is supposed to prevent bank runs. And for a while, it works. From 1934 to 2008, there are no major banking crises in the US. The system seems stable. But it's not. It's just hidden. Okay, 2008, financial crisis, and at its core, it's the exact same problem the Medicis faced in 1464. Here's what happened. Banks were using fractional reserves. Nothing new. But they'd also invented these things called mortgage-backed securities. Basically, they'd bundle mortgages together and sell them as investments. And because of fractional reserves, they could lend out way more money than they actually had. Housing prices go up. Everyone's making money. Banks lend more and more with less and less in reserve. Then housing prices stop going up. People start defaulting on mortgages. The mortgage-backed securities become worthless. Banks suddenly realize, oh crap, we don't have enough reserves. People and institutions try to withdraw money. Bear Stearns fails. Lehman Brothers fails. Bank runs. Digital bank runs. The system is collapsing, and you know what the government does? The exact same thing the Medicis would have done. They inject massive amounts of money to shore up reserves. $700 billion TARP. Bailout. The Fed lends trillions to banks at 0% interest. They stop the bank run. But here's what's insane. After 2008, instead of fixing the system, they doubled down on it. In 2020, the Fed reduces reserve requirements to 0%. Banks don't have to keep ANY reserves anymore. They can lend out 100% of deposits. The Medici trick is now completely unlimited. All right, let me show you how this plays out in the modern banking system, because the numbers are absolutely wild. As of 2024, physical U.S. currency in circulation, $2.3 trillion. That's actual paper bills and coins, real money you can touch. M1 money supply cash plus checking accounts, $18.2 trillion. M2 money supply M1 plus savings accounts plus small deposits, $21.1 trillion. So out of $21 trillion in the money supply, only $2.3 trillion is real. That's 11%. The other 89% is just ledger entries, numbers in computers, created through fractional reserve banking. Now, let me show you the multiplication in action. Total bank deposits in the US. $18 trillion total reserves held by banks, $3.3 trillion. That's an 18% reserve ratio. Better than it used to be, but still fractional. That means banks have lent out or invested $14.7 trillion that they don't actually have. And here's the kicker. If just 20% of depositors tried to withdraw their money at once, the entire system would collapse, even with the Fed as backstop, because the Fed doesn't have $18 trillion either. The Fed's balance sheet is $7.7 trillion. It's all fractional, all the way up. The Medici trick scaled to global proportions. Okay, so here's the part that gets a little conspiracy adjacent. But hear me out. Why don't they teach this in school? Think about it. In high school, you learn algebra, history, chemistry. But nobody explains how banking actually works. Nobody tells you that banks create money from nothing. Nobody explains fractional reserves. Why? I think there are two reasons. Reason number one, it would cause panic. If everyone understood that banks only keep 10 to 20% of deposits in reserve, and that if everyone withdrew at once, the system would collapse, people would get scared. Some people would actually try to withdraw their money, which would cause the exact crisis the system is designed to avoid. So it's in everyone's interest to keep people ignorant. Reason number two, it benefits the powerful. Here's who benefits from fractional reserve banking. Banks that get rich by lending money. They don't have governments they can borrow massive amounts at low interest. Because banks create money to buy their bonds, the wealthy, they get access to credit first. And cheapest, here's who gets hurt. Savers, their money is worth less because banks create more money, causing inflation. The middle class, they have to work for money while banks create it. If people understood the system, they might demand it be changed. So instead, they keep it complicated, keep it obscure. Call it monetary policy and reserve ratios instead of the money multiplication trick. Make it sound sophisticated so people don't ask questions. And look, I'm not saying there's a smoke-filled room where bankers plot this, but I am saying the system benefits from people not understanding it, and the people who benefit from the system control education, so the system perpetuates. Okay, so here's where it gets interesting for today, because cryptocurrency is basically a rejection of the Medici system. Bitcoin, for example, has nitrogen monoxide fractional reserves. There will only ever be 21 million Bitcoin. You can't create more. There's no central bank that can print more. It's the opposite of fractional reserve banking. And a lot of people are attracted to crypto specifically because of this. They're like, I don't trust banks creating money from nothing. I want a system where the supply is fixed. Now, I'm not here to show crypto. It has its own problems. But it represents something important, a philosophical rejection of the Medici trick. And you know what's interesting? Banks and governments hate this. They're trying to regulate crypto, shut it down, control it. Why? Because if people move their money out of the fractional reserve system and into crypto, banks lose power. The government loses the ability to control money supply. The whole system that's worked for 700 years falls apart. Now, will crypto actually replace fractional reserve banking? Probably not fully. At least not anytime soon. But it's exposing the system, making people ask, wait, why can banks create money from nothing? And that question is dangerous to the status quo. Alright, so let's play out a scenario. What happens if the fractional reserve system actually collapses? Not just a 2008-style crisis where governments bail it out, but a complete, total collapse. Here's how it would play out. Stage 1. The triggersome event causes mass withdrawals. Could be a major bank failure. Could be a government debt crisis. Could be a cyber attack that makes people lose confidence. Doesn't matter. Point is, people panic and try to withdraw money. Stage 2. The bank-run banks don't have enough reserves. They start limiting withdrawals. You can only take out $500 per day. This makes more people panic. Stage 3. The freeze government declares a bank holiday. All banks close for a week. ATMs don't work. Credit cards don't work. The economy freezes. Stage 4. The bailout attempt. Government tries to inject money, but if confidence is totally lost, it doesn't matter. People don't want bank deposits. They want physical cash, or gold, or Bitcoin. Stage 5. The collapsed banking system fails. Currency hyperinflates as government prints desperately, or currency collapses completely. Society goes back to barter or adopts a new currency. Now, this is worst case scenario. Unlikely. But it's not impossible. It's happened before. Weimar Germany, Zimbabwe, Venezuela. When confidence in the fractional reserve system is lost, it collapses fast, and the Medici trick stops working. Okay, so if fractional reserve banking is this fragile, why do we still use it? And is there an alternative? Well, there are a few options. Option 1. Full reserve banking. Banks only lend out money they actually have. Your $1,000 deposit stays in the vault. If the bank wants to lend, they have to use their own capital or borrow from savers who specifically choose to lend. Pro. No bank runs. System is stable. Con. Way less credit available. Economic growth slows. Option 2. Government-owned banks instead of private banks creating money. The government does it directly. This is how China largely operates. Pro. Government controls money creation for public benefit. Con. Government controls money creation can be used for corruption or bad policy. Option 3. Cryptocurrency. Decentralized systems. No central authority creates money. Supply is algorithmic and fixed. Pro. Can't be manipulated. Transparent. Con. Can't respond to economic crises. Deflationary. Option 4. keep the current system but regulate it better. Higher reserve requirements, better oversight, stricter rules. Pro, keeps the benefits of credit creation without as much risk. Con, banks lobby against regulation, hard to enforce. Honestly, I don't think there's a perfect system. Every system has trade-offs. But the current system, fractional reserves, with almost no regulations, is probably the worst version. We're basically running the Medici system at maximum leverage and hoping it doesn't collapse, alright? So what can you actually do with this information? Here are some practical steps. Step 1. Understand your bank's reserve ratio. Most banks publish their capital ratios. Look it up. If your bank has a low ratio, under 10%, consider moving to a more stable bank or credit union. Step 2. Don't keep all your money in one bank. FDIC insures up to $150,000 per account. If you have more, spread it across multiple banks. Step 3. Keep some physical cash. Not because the system will definitely collapse, but because if there's a crisis, ATMs might not work for a few days. Having $1,000 to $2,000 in cash at home is just smart. Step 4. Consider alternative stores of value. Gold, Bitcoin, real estate. These are assets that exist outside the fractional reserve system. They can't be created from nothing. Not saying go all in, but diversification makes sense. Step 5. Understand inflation. When banks create money through fractional reserves, it causes inflation. Your savings lose value. So don't just save in a bank account earning 0.5% interest. Invest in assets that outpace inflation. Step 6. Educate others. The system works because most people don't understand it. If more people understood fractional reserve banking, there'd be pressure to reform it. Share this information. Make people aware. So here's the bottom line. In 1397, the Medici family figured out a mathematical trick. Keep a fraction in reserve. Lend out the rest. Use double entry bookkeeping to track it all. And you can create money from nothing. This trick made them the richest family in Europe. And 700 years later, every single bank in the world uses the exact same system. Your bank doesn't have your money. They have about 10 to 20% of it. The rest is just ledger entries. And as long as everyone doesn't try to withdraw at once, the system works. But it's fragile. It's collapsed multiple times throughout history. And it'll collapse again. We just don't know when. Now, I'm not saying panic and pull all your money out. But I am saying, understand the game. The Medici trick is still running. And you're playing whether you know it or not. So now you know. Use that knowledge however you want. Anyway, if this changed how you see banking, share it. More people need to understand what's really going on, alright? Catch you in the next one. Stay curious, stay skeptical.